Most crypto investors do not lose money because the market is unpredictable. They lose money because their behavior is. The biggest mistakes in crypto are rarely technical. They are psychological, structural, and painfully repetitive. And they continue year after year, cycle after cycle, regardless of how much information is available. Most people believe crypto success is about finding the right coin at the right time. They think the edge comes from speed, insider knowledge, or discovering the next breakout before everyone else. But what actually determines outcomes is far less exciting. It is risk management. It is emotional control. It is understanding how market cycles really function. One of the most common mistakes investors make is confusing volatility with opportunity. Sharp price movements feel like momentum. They trigger urgency. They create the illusion that action is required immediately. But volatility is not opportunity by default. It is simply movement. When prices surge rapidly, inexperienced investors interpret that movement as confirmation. They buy not because value has increased, but because attention has increased. They anchor to recent performance and assume continuation. This is a cognitive bias known as recency bias. It causes people to overweight what just happened and underweight broader market structure. In crypto, where sentiment shifts quickly, this bias becomes amplified. Investors chase strength at the top of emotional cycles and then sell weakness at the bottom. They do the opposite of what long-term discipline requires. Another persistent mistake is ignoring position sizing. Investors often focus entirely on which asset to buy. They rarely think carefully about how much to allocate. In a highly volatile market, position size determines survival. Even strong long-term assets can decline dramatically during broader market contractions. If a single position is too large, temporary drawdowns become emotionally unbearable. And when emotions become unbearable, rational decisions disappear. Many losses are not caused by bad assets. They are caused by oversized exposure. A third structural error is confusing narratives with fundamentals. Crypto markets are driven by stories. Innovation, adoption, regulation, technology, decentralization. These narratives can be powerful and meaningful, but narratives expand faster than real adoption. Investors often price in years of growth within months. They assume that technological potential automatically translates into immediate market value. This disconnect creates cycles of overvaluation and correction. When expectations outrun reality, price eventually adjusts. The disciplined investor understands this gap. They recognize that long-term potential does not eliminate short-term risk. They separate belief in the technology from the timing of entry. Timing itself is another misunderstood factor. Many investors attempt to predict precise tops and bottoms. They search for perfect entry points. They wait for absolute confirmation. In practice, precision is rarely achievable. Markets move in ranges. They overshoot, they retrace, they consolidate. Attempting to trade every fluctuation increases transaction costs, stress, and error frequency. Often, doing less produces better outcomes. Overtrading is a silent destroyer of capital. It creates the feeling of control while gradually eroding returns. Another mistake is ignoring liquidity and market structure. In strong markets, liquidity appears abundant. Spreads tighten, slippage feels minimal. Execution seems easy. But during sharp downturns, liquidity evaporates. Orders fill at worse prices. Volatility increases. Exits become crowded. Investors who never planned for stressed conditions are forced into reactive decisions. Markets are not dangerous when rising. They are dangerous when participants need to exit simultaneously. There is also the issue of time horizon mismatch. Many investors claim to be long-term holders, yet they monitor prices hourly. This mismatch creates constant emotional friction. If the true goal is long-term participation in technological growth, then short-term volatility should be expected and normalized. But if capital is needed within months, then exposure should reflect that reality. Time horizon must match strategy. Perhaps the most underestimated mistake is neglecting macro context. Crypto does not operate in isolation. Interest rates, liquidity conditions, regulatory shifts, and broader risk appetite influence capital flows. When global liquidity tightens, speculative assets often contract first. Ignoring macro trends while focusing only on individual assets leads to incomplete analysis. Markets move as systems. They rarely move independently. As cycles progress, mistakes compound. Investors who overextend during optimism often lack capital during opportunity. Those who chase narratives near peaks are absent during accumulation phases. The pattern repeats because human psychology does not change. To avoid these mistakes, investors must build structure before emotion enters the equation, define position sizes in advance, establish entry and exit criteria before capital is deployed. Accept that volatility is inherent, not exceptional. Avoid making decisions based on attention spikes or social consensus. Monitor liquidity conditions, not just price charts. Most importantly, align strategy with time horizon. If the goal is long-term exposure, then patience becomes an asset. If the goal is short-term trading, then strict risk controls are non-negotiable. The market will always offer opportunity. What it does not offer is forgiveness for unmanaged risk. Crypto rewards preparation more than prediction. And in a market defined by cycles, the investors who survive are not the ones who move fastest. They are the ones who make the fewest avoidable mistakes. Understanding that difference is where real advantage begins. If this explanation helped, subscribe for more clear breakdowns like this. Thanks for watching.